Hello, my name is Toby Heaps. I'm the co-founder and CEO of Corporate Knights, and it's my pleasure to welcome you here today for the launch of Corporate Knights Sustainable Economy Intelligence data series. Before we get underway, I'd like to just do a brief land acknowledgement. Corporate Knights honors the peoples and land of all First Nations, Inuit, and Métis people, and their valuable past and present contributions to this land. As many of you will know, Corporate Knights has a focused mission, which is to speed up the transition to a sustainable economy. We've been focused on this mission for a little over 20 years. And part of how we push this forward is distilling and ranking the companies who are really leading the way to the sustainable economy that we need, and that is now powering a lot of our economic growth. For many years, we did this by focusing on what traditional sustainability and ESG rating and ranking agencies focused on, which was the operational metrics, the carbon emissions, the board gender diversity. All of those things are important, and they tell an important part of the story, but they also don't tell a really important part of the story, which is how companies make their money and how they're investing their money, and how their products and services are aligned or not aligned with the transition to a sustainable economy. So a little over 5 years ago now, we started at Corporate Knights to figure out a way that we could do this in an apples to apples way, because one company's definition of green is not another company's definition of green, in a way that would be consistent, where we can measure companies across industries, across the planet, on a criteria that would be apples to apples in terms of what qualifies as a sustainable product or service. So we started coming up with this methodology, refining it. We went, at the time, the EU was coming together with an initiative to form a taxonomy. We'll hear more about that from one of our panelists here today. And many other initiatives were underfoot, and different initiatives had been done about green GDPs and different taxonomies associated with the United Nations Sustainable Development Goals. And we distilled all of that in combination with the raft of sort of eco and eco labels and eco certifications that exist around the world, whether it's for sustainably sourced forestry products or organic food or non-GMO food, the whole sort of raft across all industries, smart buildings. And we came up with a criteria to distill which eco labels were credible departures from business as usual, and in line with progress, meaningful progress towards the Sustainable Development Goals. And then over the 5 years, we refined this taxonomy classification system. It's called the Sustainable Economy Taxonomy, working closely with our research team and our director of research, who will hear more about that on this panel today. We're now on version 6.0, 7.0 is coming out later next month. And we also added, in addition to how companies make their money, how they're investing their money, their capital expenditures, their R&D, their research and development, and their acquisitions, because how a company invests today tells you a lot about what it's going to look like tomorrow and what its values are. And so we're really happy to, we've completed now this data exercise, filling in data for approximately 2,500 companies across the planet, publicly traded companies, meaningful emitters, and large companies across all sectors. We now have the data fill for 3 years of numbers. And we've sourced this data not just from the publicly available sources, but also by interacting with many of these companies, upwards of 500, representing about $17 trillion of market cap, and asking them specific distilled questions to get specific answers that allow us to either quantify or count or not count different facets of their revenue book and investment book. So we're super happy to be here with everybody here today. We have an all-star panel of people who are really moving the needle in this space in their respective milieus. And before we get going, I thought it's always useful for people to know what you're talking about. So we're talking about sustainable economy. We're talking about sustainable revenue, sustainable investments. What does sustainable even mean? There's a whole raft of activity going on around the world trying to define and tackle this precise problem. Corporate Knights is trying to act as a synthesizer, a practical real-time synthesizer of this. But somebody who's been in the middle of this, driving this from the outside and working now on the inside, and also pioneering a whole massive new asset class of green fixed income and green debt. Sean Kidney, co-founder and CEO of Climate Bonds, is with us. So Sean, I really appreciate you beaming in from wherever you are in the world, overseas from where we are in North America. And I would love if you could just give us a bit of a landscape view on, what does sustainable mean in the context of this sort of ESG measurement and revenue and investment context.
Hi, Toby. I'm in Mumbai at the moment in a hotel foyer, so there may be background noises. My apologies. Talking sustainable finance in India, where it's nighttime, not morning. Look, the background to the taxonomy approach, the definitional approach, came from the green bond market, where the specific references you're making came to green bond market, where we had a use of proceeds model rather than an ESG for entity model. You might recollect that ESG and equities grew up around how to assess a company. And various shades of color of companies therefore came about, with, of course, every different consultant having their own methodology. There's a wonderful graph of a correlation between, showing the correlation of the top 500 companies in the world between Sustainalytics and MSCI, which shows zero correlation. There is none. Like, it's bizarre, but nevertheless, in the taxonomy space, as green bonds grew, we at Climate Bond started saying this has to be a climate-focused thing because it's a dominant challenge. So it was very much how to address climate. We started publishing a taxonomy in 2012. We started work on that, and the idea of a relatively simple commoditized shopping list was consistent with a standards-based approach to growing markets, according to the actors we were working with. If you want to grow a market fast, you've got to simplify the cost of transaction, but you've got to have boundaries, combination of both. And that's where it started. So the idea was, especially in the green bonds market, which grew up as a use of proceeds market, that means a company that had a bunch of stuff could issue a green bond just for the green stuff they're doing. Full faith and credit. This is very attractive to investors, by the way, because it meant a whole pile of companies of high credit ratings they're investing in were suddenly available for their green portfolios or greening their portfolios. The story has worked quite well, but it all depended on a common language. And initially we had, let's say, the property sector in the US, a lot of different kinds of green bonds coming out. Some really good, Wanado, I remember. Some, I won't mention the names, well, crap, frankly, hardly any ambition at all. So the idea of a common language of appropriate definition, consistent with the Paris Agreement when it came along, then became the guiding principle. And in 2014, we convinced the Chinese government to introduce what they called a green products catalogue. They were worried about scams in the provinces. It worked. It's now the second largest green bond market in the world. We convinced the European Commission, when I was a member of the high-level expert group on sustainable finance, to do it. They called it a sustainable taxonomy, but the objectives initially were climate and still remain the primary objectives: climate mitigation and adaptation. There is ambition in the European context to expand the taxonomy into other areas of environmental sustainability, but that hasn't actually moved ahead at this stage. And I'm cool about that because we've got to make the climate stuff work first, if you like. And there's some challenges in making other things work. As soon as you get governments involved, always there are challenges, competing groups and so on. But we are having reasonable success with a simple idea, which is to introduce a common language across the finance sector of what you can call a climate-related investment. That's what it is. We've taken that global now. About 30 countries around the world have done taxonomies or in the process of doing taxonomies, including India, where I am now. Canada's had a shot at it. Investors in Canada knocked it back for good reason, frankly. And you'll see a second try now underway, which we're confident will do the same as being useful for Canada, but also being broadly equivalent to other countries, so we can have inter-country capital flows. And at the end of the day, the basic principle of the European taxonomy and the Canadian taxonomy is science-based. So the key difference between, let's say, previous attempts to try and categorize what should be done around climate, usually caught up in national climate change plans, NDCs in the parlance, was that they were creatures of political economy. They were what the scientists are saying, and then saying in the ministers of finance or ministry of environment, oh, that looks really tough. I know they're right, but I think this is all we can do at the moment. And that becomes an NDC. Well, of course, that hasn't done us very well in the last 30 years. Emissions went up again last year. So there are problems. The science-based principle now established and reinforced in the G20 principles for taxonomy development links it to the IPCC report and gives us the framework to have a common ground. In other words, what counts in Chile is the same as what counts in Canada, when it comes to energy, et cetera, et cetera. There are complications in detail, but I would say the key point is it's a shopping list for the future with an emphasis on removing the cost of transaction. We don't want companies to be making complex justification for what qualifies in the taxonomy discussion. We want to tell them what qualifies, and they just tell us whether they're doing that or not. And by reducing the cost of transaction, we encourage the growth of a sustainable finance market. And that's what you're seeing around the world. In the bond space alone, we're at $3.5 trillion outstanding now. And after a flat year because of the Ukraine war last year, we're on a rocket again this year.
Okay, that's a really helpful overview. And I think you're a bit modest in the role that you and your merry band at Climate Bonds have played in really activating and catalyzing and accelerating and originally pioneering, the taxonomy with the Climate Bonds taxonomy, which was is something that we, as you know, we work closely with your colleagues and ensure that we're aligned with. And it's great to see the EU making something official, making this language official for the most important part, the climate mitigation to start, and adaptation and other aspects of social and environment to come online in due course. In the meantime, the Sustainable Development Goals are an issue for all of us. And while they're getting officialized, at Corporate Knights, we've made an attempt to bring it all together. The EU, we call it the EU plus approach. So we kind of tackling the climate bonds, EU, and the SDGs in a way that we could stand behind and credible. We always did this because we wanted to figure out who is leading the way to a sustainable transition. And we needed this data to be able to do that in a practical way. And we've learned a lot engaging with companies on different nuances, different sectors, and they've had a lot of helpful advice. So, much of it we've taken, not all of it, but much of it has been quite helpful. And Ralph Torrie, who's our director of research and has his own storied past in the sustainability movement, going back several decades now, including being the individual who led the committee that wrote the first global greenhouse gas emissions reductions target at the first global gathering of world leaders in Toronto in the late 80s that Mulroney hosted. Ralph Torrie, and Ralph's going to give us a bit of a high-level overview of what this new language looks like when you look at it in spreadsheets and in data and the real economy in terms of investment and revenue. And one of the things that we'll hear after from Olaf is we know that the parts of the economy that are growing the fastest tend in most cases to be the parts of the economy that are on the leading edge of the decarbonization, whether it's electrification, transportation, cars, smart buildings, on plant protein side, or on the shift to renewables in the electricity grid. We see the tremendous growth occurring, and you see it in the numbers that Climate Bonds publishes with the $3.5 trillion of outstanding debt, which is orders of magnitude more than there was less than even a decade ago. So I'll pass it to you, Ralph, and please give us a tour of what this looks like in the real economy, bring a common language together.
Thank you, Toby. So I will necessarily be going over this at a fairly high level and fairly quickly, but I'll try to give enough background on what we've been doing in this space at Corporate Knights to get the conversation going, because I'm anxious to hear from the other panelists myself. Essentially, just to give an overview, and you've had an introduction to the basic idea from Toby and Sean. This particular effort that we've been putting into identifying sustainable revenue and sustainable investment activity that's contributing to the transition covers, we're well up over 2,500 companies at this point. It's global in its scope, all industries. 2019 is the first year for which we have revenue and investment tracked for these companies. We pull the data from annual reports, sustainability reports, anywhere we can find it. Basically, the Climate Bonds Initiative has been very helpful in pointing us to some leading companies. We use the Carbon Disclosure Project filings. And perhaps most uniquely with regard to what we're doing, we lean into direct engagement with the companies through an online portal where they can both submit their own data with evidence that will allow us to verify it and engage with us in back and forth, which often leads to improvements in our own method and approach and gives us information from the companies and quality of of data that is simply not yet available in easy to find reports, and sometimes only comes into us through these interactions that we have with the companies. We're updating it all the time. It's officially updated every month for subscribers. And let me just, well, we've now looked at we've now identified $10 trillion of what we define as sustainable revenue. More on the definition in just a couple of seconds. 1.3 trillion of sustainable investment over this 3-year period. And we are adding to this every day. We have a team of people here who are focused and have been now for some time in adding to this database, which has now, I think, somewhere north of 15 to 20,000 records in it. The basic structure of our taxonomy is illustrated in this slide. Each column represents what we call a tier 1 level of our taxonomy. So we divide it into buildings, energy, vehicles, primary production, that's the steel and the cement and so on. Green products, which is a very large category encompassing all manner of manufactured products. We have a category that focuses specifically on water and waste management systems, ecosystem restoration, and so on. Telecommunications and IT are in a separate category. We'll have probably a little more to say about that before the morning is over. We have a category that tracks essential medicines and related technologies. And finally, a finance and insurance category, which is rounds out the taxonomy. That very last column, consulting and business services, is really just a place where companies that are in the business of providing support to companies that are whose products and output qualify on any of the previous 9 categories can be included in the taxonomy. It's a pretty small set of numbers, as it turns out. And each one of these categories is then divided into a number of secondary categories. And there's no time now to go into these in any detail, but the details of our definitions are online. We are deeply committed to transparency in our methods and our definitions, and you can find all of this on the Corporate Knights website. This next slide is just a very quick zooming in at the buildings taxonomy definition. So we will start out with a general definition of what constitutes sustainable buildings in our system, and then we'll break it down into those tier 2 categories. So in this case, design and construction, owning and managing, provision of HVAC equipment to those buildings or materials to those buildings. We define what we mean in each of those cases at the tier 2 level. We also have done a fairly exhaustive review of several hundred eco certifications over the whole scope of our taxonomy. And we picked out a couple of dozen or a few dozen that meet our fairly high standards for what we will accept in terms of certifications that indicate sustainability. Again, all of these are on the website in quite a lot of detail. And as I mentioned, and as Toby mentioned, we do respond to the feedback we get from people who are participating with us on this and continuously are improving and updating this. There'll be another revision of the taxonomy coming out next month. We've heard a couple of these numbers already. We've looked at over 7,500 company years of data in the revenue category and over 6,400 company years of data in the investment category, covering these nearly 3,000 firms that I was mentioning earlier. We're finding sustainable investment, in other words, a non-zero result in about 38% of the instances for when we look for the revenue, and about 46% when it comes to investment. So fairly encouraging. The percentage, however, of the revenue and investment as a share of total revenue or total investment is still under 10%. And this has been corroborated by other work that others are doing. So we're pivoting, but we're not where we need to be to get this transition completed over the next 10 years. But all told, we've identified over $10 trillion of sustainable revenue and north of $1.3 trillion now in sustainable investment. Very quickly, just to give you a sense of the what the granularity of this database allows in terms of analysis. Here you see a breakdown of sustainable revenue by industry. Basically, we have what we call corporate Knights peer groups, of which there are 62, I believe, and we can break the revenue and the investment down into any of these groups. So every company is assigned to a particular industry group. So in this case, you're looking at that $10 trillion that I was referring to a moment ago, and how it breaks down by the top 20 of our industry categories. In this chart, you see the same $10 trillion, but this time broken down by our tier 1 taxonomy categories. You might raise your eyebrows at the appearance of telecom and information technology in that lead position. We do, at this point, consider the enabling capabilities of telecoms and IT as sustainable. We do discount it to the extent that these firms are taking their revenue out as opposed to plowing it back into additional development. But even after having done that, the numbers are quite large. This is, as many of you would know, is an area of active debate right now, the extent to which telecoms and software and information technology, enabling technologies of the sustainability transition, ought to be credited. So we're reviewing that as we do for all of our definitions on a continuous basis. But you can see renewable energy, green products, the emission-free vehicles leading in the sustainable revenue that we've been able to find. We're also able to break down the revenue for, let's say renewable energy, which is what this example shows, by the industries where it's taking place. And of course, power generation and power transmission, that's where you would expect to find most of the renewable energy revenue. But because of the way we've decoupled the categorization of industries into the peer groups and the categorization of sustainable revenue and investment, we can also identify where the key supply chain companies and industries are in play with respect to each of the major segments of the sustainability transition. So here for renewable energy, you can see machinery manufacturing is a significant industry in the supply chain. That's largely the wind turbine manufacturers. Of course, the semiconductor industry is there in relation to the solar element. Interestingly, the refining and petrochemical industry shows up as an important contributor to the renewable energy development. This is reflecting the investment or the revenue that is now being earned from biofuels by some of the companies in that space. The battery manufacturers, of course, are there. And we're working hard to try and make sure that we continue to add to our understanding of the supply chains for these, what you might call the rock stars of the sustainability transition, the power, the renewable electricity, the emission-free vehicles, and the emission-free buildings. Similarly for investment, same charts, only this time if you see red is the color I've been using to characterize investment. So here you see that 1.3 trillion I referred to earlier, broken down by industry groups, and you can see power generation, again, far and away out in the lead, but important contributions from the vehicle industry and other industries which are really critical to the sustainability transition. Here we have, once again, that same 1.3 trillion, only this time broken down by our tier 1 taxonomy categories. And as with the revenue, we can then take that further and show how the investment associated with renewable energy on the left and with emission-free vehicles on the right, these are the two tier 1 categories that I chose to highlight. We can see where that investment is coming from. And not all the investment in the renewable energy sector is coming from the energy industry. There are significant contributions from the manufacturing industries that are supporting that supply chain, and we're able to track that separately. And by implication, we can also track the companies that are not yet on the train, or maybe need to be, maybe making the investments, but not yet seeing the revenues. So it becomes a very powerful tool for investors to gain insights into the dynamics of the transition, not just a snapshot. Another interesting thing, Toby mentioned that and this is the last point I'll make, that our investment, second last point, that our investment numbers break down into three subcategories: capital expenditures, research and development, and acquisitions are the three numbers that we include in our definition of where the sustainable investment is taking place. And here you can see that over our whole universe, it's about 79% CapEx, 14% R&D, and 7% acquisition. But again, the granularity of this database lets us dig in deeper and see what are quite important trends to understanding both where the opportunities are and where the different sustainability segments are in terms of the tipping point where you really see a big shift over to revenue and CapEx and away from R&D. And for example, here you see those same two sectors I had up earlier compared with respect to how their investment breaks down. For renewable energy, it won't be much of a surprise. It's all about CapEx and acquisitions at this point. I won't say the R&D is over, but this train is moving. Whereas with emission-free vehicles, which is just right on the cusp of its tipping point, I think, you still see a much larger percent of the sustainable investment going into research and development as opposed to capital expenditures. I'm sure when we show this chart 2 years from now, that pie will start to look a lot more like the one that we see for renewable energy, because the electric vehicle wave is just on the cusp of turning the corner on the steep part of its curve. My final slide is just to show, I mean, even though we do all of this analysis without regard to the financial performance of any of the thousands of companies that we're looking at, when we're finished, we then created an index that shows how the leading 100 companies in our overall system, the so-called Global 100, performs financially as compared with other leading or at least well-known market indices. And once we started getting this sustainable economy intelligence data into this system, the Global 100, which had always either tracked or led the other indices, really started to pull ahead. This is perhaps one of the most encouraging things, and I'll end on that note, that it's really clear at this point that the companies that are making the products and providing the services that we need to get through this sustainability transition are also doing very well in terms of the return on investment and the market value of those companies. And so you can do very well by doing good, which is what we set out to explore, and that's what our data so far is indicating. So that's a very quick overview, and I'll turn it back to you, Toby.
Thanks, Ralph, for the overview. We also have with us Olaf Weber. Olaf, many of you will probably have run into him. He's a globally quite well known in sustainable finance, done work around the world, China, Europe. He's been longtime chair of sustainable finance at the University of Waterloo. And many of his students have come through Corporate Knights and have probably worked with some of you who are on the call, or some of them will work with you. But he's really a factory of sort of sustainable finance powerhouses coming out of his retinue there at University of Waterloo. And Olaf agreed when we completed the data set with 3-year history. He agreed, he was curious and agreed to take a look at it and do some preliminary testing to see if there were relationships that look promising for further investigation. So with the caveat that there's further investigations to be done, we thought it might be interesting to just provide a high level sort of some of the more interesting notes that Olaf discovered in playing with the sustainable revenue data and this and the sustainable revenue data was more filled out. But Olaf, over to you. We'd love to hear what you learned and what merits further investigation. And I believe there might be a slide too that Chris will pull up.
Yeah, thanks a lot, Toby. So yeah, just again as a disclaimer in the beginning, I've seen the data last week the first time, and so this is far from any kind of don't try and figure out what exact numbers we found and stuff like that. But I will try to give you a certain overview. I think in general the problem is is, as it has been mentioned before, there are many studies that show the impact of any kind of ESG or sustainability activities or corporate sustainability behavior that is positive on the financial performance. We have hundreds of thousands of studies on that, of course. The question is, there's a certain variation on that, and the question is, what can we do there to solve that problem? And I think this approach that Corporate Knights has used now to find data on sustainable revenue and sustainable investments is the next step in the field. So I think especially what we try to do currently is to work on financial models, and these financial models get more sophisticated. So these are the kind of models more or less that are developed, let's say, in the space, like you go up in space to do your experiments, then you come back to Earth, and then you try to connect them with ESG or corporate sustainability data that is pretty, let's say, preliminary and probably not very reliable, and try to correlate that. And of course, it creates some issues. And so I think really working on this ESG data space, it definitely makes sense. So, but what we found in a very first step is I tried to analyze, okay, what is the impact of sustainable revenue on total revenue, and what might be the impact of sustainable revenue on total share price returns and in future years. So the interesting case is here to say, okay, we have some data of sustainable revenue, let's say in 2019, is there an effect on the total revenue in 2020 or to 2021? Again, I have to say, I didn't use any control variables and stuff like that. So usually we'd use, we focus on abnormal returns and need all the other variables that have an impact as well. And maybe you could see that as well when Ralph talked about the IT telecommunication sector. Currently, you have a clear, it goes down, total share price go down because of other reasons. They lay off many employees and so far. On the other hand, fossil fuels go up. We know why. There's a war, and everybody looks for gas and oil. And so these factors are not controlled at all in that studies, but they play a big role. What we can see in general is that we have the total, there is a correlation, a positive correlation between sustainable revenue and total revenue. We can see that in this graph as well, and this is significant. So I did panel regressions and all these things. So there's a significant connection to that, the correlation to that. What we can also see, and that was something that Ralph mentioned before as well, there are many companies that are at zero with regard to sustainable revenue here. And so this is an issue, of course. We have many that either don't have sustainable revenues or we didn't find them. And I think this is important, are we really able to figure out, whether they have sustainable revenue and the same for investments or not? And this is nothing, to criticize the study here, but it's the question. There's no regulation on that. There is no regulation on how to report, sustainable revenue, sustainable investment compared to others. It's voluntary, and we have to figure out whether it's correct and whether it's there or not. But I think what we can see in general, and this is here. So if we look on, so for instance, as an analyst, if you look on data on sustainable revenue of a company, it helps you in a way to predict the total revenue of the next years. And so there is a significant impact and a positive correlation. And the same for the total share price return. So what we see here is, and that many other studies show as well, that we have a positive correlation between both. And we have also a predictive ability. So it's not only that we say it's coming up at the same time, but we can use the sustainability figures to predict total returns and total revenues in the future. And I think that's the good news as a first step here. When I start a study like that, if I don't find a negative correlation, then I'm happy, because that's the first step in the study. And we say, okay, it looks like there is something, and it makes sense to go to do that, to do more research on that. And that's the plan. So figure out, okay, what are additional indicators that we can use, which kind of models that are generally accepted in the investments worlds we can use, and to add the sustainable revenue part or the sustainable investment piece into these models. And I think this might help investors or analysts to use the data that Corporate Knights found there, and helps them to in their investment, in their future investment, and helps to figure out what the role of sustainability investments and revenues are for companies.
Good. Thanks, Olaf. That's really helpful, and I think it's promising to see the positive correlation to revenue and share price return, sustainable revenue, and the predictive, the significant predictive relationship as well. And so it'll be interesting. We'll be interested to bring you back and to follow the work as sort of delve deeper into this. I think a lot of people will be interested to look at whether there's a isotropic relationship, if it cuts both ways. I know there's folks looking on the hedge fund side. Could be interesting to kind of have a long short strategy where you're shorting the ones who are going down, and on the sustainable investment revenue, the ones who are going up, going long. In terms of the question you raised too about the coverage, it's a critical issue. And when we sort of went looking to see what else was in the market, there's one other provider that has a sort of sustainable CapEx field, EU aligned CapEx. And we went to look at what the coverage was, and it was they'd identified values in a little less than 1% of the companies. So over 99% of the companies, there's not much to go on. And so we still have a lot of work to do, and we're really trying to bring the number up. But I think it's encouraging that we've identified values, activity with numeric values in upwards of 40% of the companies on the investment side. And so I think that we need to color in about half more of the picture, but there's a fair bit that I think can be done when you have half the picture colored in already. And so I think we're getting close to that point. The reason we're doing this, and I said at the outset, is we really just want to speed up the transition to a sustainable economy, and you have to have a common language so people can kind of navigate and communicate and locate where they can deploy the capital to do this, because what gets funded gets done. And we're really happy to have with us today Fate Seguir. Fate's the Senior Vice President at Mackenzie Investments, Head of Sustainability. And we have been working with Fate for the better part of the past couple of years. Fate's company, Mackenzie Investments, is a subsidiary, is part of the IGM family of companies. And IGM is running 4 years now on the Global 100, is sort of one of the leading asset managers globally in terms of deploying sustainable finance consistent with our taxonomy. And we've been working closely with Fate and her team at Mackenzie on how these insights could be deployed into investable strategies. And happy to report that there'll be something that people can invest in coming this April around the Global 100, which is a sort of synthesis of the sustainable economy metrics and the operational metrics that we look at with the 50% weight on each. But Faye, it'd be great to get your perspective. You see everything that's going on in this space, and you just from you and John Cook and Greg led the sort of integration of Greenchip, which is one of the pioneering sort of green investment strategies in Canada, focused on green solution providers. And it'd be great to just sort of get your take on, how this kind of data can be used to be integrated into mainstream investing and to produce better products.
Yeah, thank you, Toby, for the question. And I think just on the comments in terms of data gaps, like, oh my goodness, this continues to be such a challenge, right? There isn't a perfect solution out there yet. And I get questioned about this often internally. We have 17 investment teams, almost a couple of hundred investment professionals that my team and I get the pleasure of working with. And as far as we're concerned, we all need to make progress. So I really appreciate what Corporate Knights has done in terms of putting together a taxonomy and trying to create some prescriptive nature to move us forward. And in the EU, I really appreciate the taxonomy that's been released there. In Canada, Sean, you said it, we're still sitting on our hands waiting to see what happens there. So this gives us something to point to. And I think it's important while we get some of the reporting regulations and so on in place. But maybe, there's a couple of things in terms of, sustainability and sustainable investments that we've traditionally looked at. And I think, Sean, again, you touched on this, like earlier when sustainable investment or responsible investment funds, however you want to, ESG investments, when they came to be, they were very much focused on, ESG metrics, right? Which we think of them as two main buckets. There's a corporate behavior and kind of that, a company's social license to operate, right? How are you treating your employees, pay equity, diversity policies, labor rights, and so on. Governance obviously being a big focus for asset management. And then there's, and that's traditionally what a lot of the academic studies on correlation of investment funds or sustainable investment funds to returns, they have been focused on many of those behavioral elements. I think what we're seeing now, and with this taxonomy that Corporate Knights has launched, but also Toby mentioned our Greenship team, they do very much focus on green revenues specifically and the environmental economy. There now you're seeing a shift at the other side of the coin. So, and if we take a step back, to us then sustainability isn't just about how companies behave, it's also about what are the products and services that you're bringing to the market? What is the impact associated with those services and helping, meet a more sustainable future? And from an asset management, perspective, there's a couple of key things to consider. Number one, the availability of capital that's coming into the space that make it really exciting to invest in. So, think about, I think there's numbers in the range of $9 trillion to $12 trillion that we need per year to achieve our 2050 goals. And now you're starting to see a lot of legislation, most recently the Inflation Reduction Act, that's dumping a lot of capital, right? Lowering the cost of capital for companies to transition. So what that does is, from an investment perspective, it makes it, a really good opportunity, because you'd expect there's going to be capital freed up for other revenue generating opportunities. The shifting demand, whether it's the regulation that's coming, I was just looking yesterday, in the EU, the cost of carbon's now at €100. Like, that's crazy, right? Like, wow. And imagine we're going through, like, we're talking about, energy security. There's all kinds of issues we have with the unfortunate Russia-Ukraine conflict, but in the European firms are still held accountable, and they're paying such a high cost for carbon, obviously much higher than what we pay in Canada. And then you have shifting client demands as well that we can't forget about, right? So consumers are becoming much more educated in this space. They're not going to want a deal, use Blockbuster as an example. At some point, these companies that are not transitioning and thinking about what value and what impact the products and services they bring to the market, they may face extinction. And then, the last piece of, the third piece I think that to consider, and to me, this is like the cherry on top, is there's an associated level of impact when you do start to think about revenue, because now you're actually solving real world problems. So yes, I have a responsibility to operate as a company. I have the traditional corporate social responsibility metrics, but now it's what is the impact of the products I'm bringing out, and how are they impacting the transition? So those, I think my first comment on the lower cost of capital is one that's really exciting for traditional investment managers and asset managers. But I think remembering the shifting demands and the impact that's associated with revenue or investment analysis is really key as well.
Thanks, Fate. That's a great overview. And if it's not, I think it's okay for him, because we have questions coming in on it. But we have a question from Jennifer McCord asking, I alluded to earlier, but asking, is there a mutual fund or ETF for investors that uses the Global 100 in its portfolio. And I thought you might be able to speak to that.
Yeah, thank you for the question. So the plan is to launch both an ETF and a mutual fund. This coming April, we'll be finalizing the dates in the next month or so. We're just, it's really, another catastrophe that you can argue is climate change driven or not, but unfortunately there's a name that's in Turkey, and we had some delays with the Turkey Stock Exchange. So we are the Turkish, Stock Exchange. So we'll announce the exact date in the coming weeks. And maybe just on that as well, Toby, I should mention that, and Ralph showed this, when the team at Corporate Knights introduced the sustainable revenue and a sustainable investment as part of the Global 100 methodology, that's where you really saw the ramp up. So we're happy to share some of the performance data, but on a cumulative basis since the inception of the index, it's outperformed the MSCI ACWI quite significantly. So happy to share more information if anyone's interested.
Thanks, Faye. We have some questions coming in. I have a couple of questions as well, but there's a question for you, Ralph, from Liz Addison, asking, do companies producing emission reduction products, hybrid vehicles, heat pumps designed for use with other energy sources, carbon capture and use processes, do they have any place in CK's taxonomy, or do products have to be emissions free? And I know there's some nuance to this, but can you give us a little color?
Yeah, I mean, the short answer is yes. Those types of products can qualify in different parts of the taxonomy. The gold standard for us is zero emissions. That's what the science is telling us we need to do. So in the taxonomy, we really are looking for zero emission buildings, for example. Similarly, with respect to vehicles, we're looking for zero emission vehicles, but we align with the EU taxonomy emission standard on that, which would admit plug-in hybrids as acceptable for the time being, at least. With electricity, we really are looking for zero emission electricity. Carbon capture and storage is included in the taxonomy. Frankly, we're not seeing, well, there's no real revenue there yet. Maybe there never will be, but we have provision for it, as we do for investment in that technology. And we do reward efficiency. And so the heat pump and other technologies that can advance efficiency can get credit in the taxonomy. And as I mentioned, all of the details of this are spelled out in a very transparent way on our website. And I would encourage people who are interested in those details to take a look at the full taxonomy on the website. And of course, we're happy to respond to any questions as you get into it.
Thanks, Ralph. I see, Olaf, you have your hand raised.
Yeah, just what Faith said with the carbon price. So we did another study on credit risk and in the Canadian TSX. And what we found is that if you increase the carbon price, let's say if you have $100 or what is planned in Canada is 170 in 2030, many of the companies, particularly in the energy sector, will move down in their credit risk to the risky zone. So if you use a Z-score approach, for instance, if you just add the costs, to the of carbon emissions. So again, this shows how important it is to have a look on sustainable revenue and sustainable investment as well. It's not only if you want to invest green because you think it's great for the environment, but it's just the mechanism to control and to manage the risk.
Thanks, Olaf. We have a question here from Mana Nagasi. She says, we'd like to adopt the sound transition framework, assessment framework into the investment process. Data is scarce, for example, CapEx aligned to decarbonization plans. It's difficult to locate or estimate. Short-term plans lack details. Yeah, those are all real issues. A lot of companies, of course, are signed up to the Science-Based Targets Initiative, and they have plans. But I think it's really it's much more honest in some ways to look at the CapEx, because you can tell, if those plans are being funded and financed. And so you're right, not a lot of sources out there. As far as we know, the only source right now for sustainable CapEx aligned to decarbonization is with broad coverage is Corporate Knights, and we know others are working, and we're definitely working every day to maintain an edge and expand that coverage?
Well, there are different approaches, Toby. I've got to
Sure,
say
please jump in.
the shortcut is a linear transition, and that's what we're seeing a lot of investors using. But transition is about bringing high carbon to low carbon where we need that high carbon, as well as things like property investments and so on. And in a portfolio, if you invest in something that's currently high carbon, which may have a really robust transition plan, you're going to blow out your carbon figures for a few years. So the linear approach involved in some of the models that are around is actually not conducive to the transition plans that we're seeing coming through. I mean, the way we've tackled this at Climate Bonds and to a certain degree in other taxonomies has been to identify two things. First, investments that are specific for a use of proceeds bond that would be relevant. So, for example, if you're a steel company, emissions are terrible, but electric arc furnace is part of the change. There are also some things that may be low emissions, not clean emissions, which are relevant, which are all conducive to, part of understanding what a CapEx transition plan should be for a company. The second thing we've done was we've published trajectories of emissions in different sectors. If you sit below that trajectory, let's say the IEA net zero steel trajectory that we use for our steel criteria, you could qualify as a Climate Bond certified company. But if you've got a corporate strategy, a transition plan, CapEx spelt out, annual reporting required, and a short time frame, like from now to 2030, then you get certification as a transition company. Your emissions today could be really way up there, but the nature of your plan is going to get you where you need to be in a commensurate time frame. So there is a bunch of different ways of dealing with the concept of transition. It is absolutely correctly something that we have to promote, work on, and utilize. But methodology from a few different ways to look at it. In Japan, where I just spent the last week, we've very much got a technology roadmap approach being used. So let's look at the specific investments required that'll get us somewhere in a good time without carbon reporting necessarily being part of it. There is a macro understanding of the carbon reporting, but not at a issuer or a industry specific level. They've just got to build a whole lot of X, Y, Z kit. And that makes it in some ways simpler for investors, but investors need to be cognizant of what the macro picture is to be able to get the justification for that. But I'm really aware of the need to be careful of cost of transaction filing out and comparability, all these things. So it is a moving feast. I appreciate that there are different models we're trying to work to bring together over the coming year.
I'm glad you brought that up. And actually, there's a follow-up question I have for you on it. But I think it's so important to sort of emphasize that a large chunk of the emissions reductions that are going to happen are in high emission sectors. So if you're not investing, and those sectors in many cases need trillions of dollars of capital over the coming decades to do the decarbonization. So the sort of walking away and taking your ball and going home strategy in many sectors who do have a path, like in steel, electric arc furnaces, later on green hydrogen, and cement, all sorts of different technologies now to dramatically reduce the emissions footprint of manufacturing cement, mining for electric mines for low carbon essential minerals. These sectors in the chemical sector as well, and even potentially parts of these sort of liquid fuels sectors. We're seeing Neste, traditional oil refiner, large oil refiner in Northern Europe, has made that pivot, and now it's 85-90% of their capital expenditures going into investments to produce sustainable aviation fuels, biofuels that come from sustainable sources, with palm oil not being among the sourcing, so real sustainable sources. So it's so important to get your hands dirty and not just kind of stay clean in order to be part of the solution. And I think, so I'm really glad you brought that point up. And there's different ways of identifying. And I think what investors are looking for is they're sort of looking for, there's no perfect kind of map. They're just looking for, give me an idea about the folks who are kind of on their way to that future and that decarbonization process. And I don't know if it's not come to market yet, but I know you and Climate Bonds have been working to come up with more of a simple kind of, couple labels so you can kind of slap on companies and their issuances in that respect. And I think if it's okay to share, I think people would be curious to hear about that.
Sure. I mean, it's what I was saying before. It's pretty simple in a way. You can get a label that you qualify now, but in some areas the qualification is involves a moving goalpost. So in the steel industry, I mentioned, if you're already a reasonably low emission steel producer, you'll fit below the reducing trajectory, which gets to net zero by 2050. There aren't any that I know of at the moment, but there may be. If you are a transition company, that is, you've got a good, robust transition plan that will lead you to get out of that declared threshold, published threshold in a certain amount of time, you get a transitions label. That can be for entities, that is a company, and in the case of debt world, that means that any debt that company spins off, then it qualifies while they remain compliant, which is subject to an annual third-party review. That's the kind of idea around it. We've published in chemical, steel, cement, property, shipping so far. We've got a few others. Of course, the story on that is not being talked about here is oil and gas. You referred to it. The Neste is a really good example of a transition company, but that's really because we understand that we're going to have some kind of synthetic fuels for the aviation industry in particular, because there is another pathway. In other words, the interrelationship between different industries has got to be understood before you can look at a specific solution in one sector. In that same with hydrogen, we need hydrogen for steel and so on. It may not necessarily make sense if it wasn't for the fact that it's a turnkey solution for a whole lot of other areas. We're not so keen, based on the IEA's pathways, to look at new oil and gas. It's not consistent according to all the modelling we've seen. But there will need to be some sweating of existing assets as we slowly, fairly quickly, remove them. And so we're going to start looking at, what does that mean? What kind of investments in existing assets, while we're having to keep operating them, would reduce emissions substantially, therefore help, and not necessarily extend the life of the asset so it becomes a stranded asset. There's a space there that's got to be explored, but not this year's priority.
That's a good point. And we're getting close to time, but we do have one question I would love to go to Fate on. And just before that one, I'll quickly address from Liz Addison, and it's on the topic that you were just discussing, Sean. And in Canada, there's something called the Pathways Alliance. It's an alliance of the oil sands companies. They kind of took over the front page of the major newspapers this weekend with a nice story about the decarbonization plans. I'm from Alberta. Lots of that's where these companies are located, and I would love to see them make the transition. And there's all sorts of pathways, especially on the using the bitumen to make advanced materials that are really valuable. And even on the biofuels side, there's some interesting, and there's a lot of opportunities. But I think the question here is, these companies claim to have a plan to reach net zero by 2050. Is there any reason for investors to believe them? And I would say, let their capital expenditures, be your guide, and you can tell a lot, by how serious they are by looking at the capital expenditures. And I'd love to see the capital expenditures, aligned with the low carbon economy, start to sort of reach double digits and then go higher. And we're monitoring that carefully. We've seen that happen with other majors. Total has hit about a quarter of their capital expenditure investments in R&D into low carbons, as has BP, even notwithstanding BP's sort of slight sort of retreat earlier this last week. But we see significant companies, majors, not just Neste, going into the sort of double, in a quarter space. And when you get to a quarter from 2 or 3% over 3 years, that's an interesting trajectory. So I'd love to see that happen in Canada. At the moment, the numbers don't bear that out, but there's no reason why they couldn't. And so the last question we have for Fate is about greenwashing. It's a concern. I'm curious if there are any successes by companies to simplify ESG complexity for a retail consumer, who's walking down the shopping aisle, sort of wondering, what's a better choice, in the consumer or investor side. But would love to hear your perspective on that, Fate, before we close out.
Yeah, good question. And I think while the disclosure requirements in Europe are quite extensive, I do appreciate how prescriptive it is, and it leans on a taxonomy. So you can, a higher taxonomy alignment kind of warrants you, an Article 8 or 9. So I appreciate what Europe's done. I believe in Canada, in the US, it's likely going to be very much disclosure based, and I wish that it was going to be a little bit more prescriptive, because it would make it much easier for investors. But maybe just a bit on, you know, where we're going in Canada is essentially there'll be 3 buckets. And this is where we had a conversation with the Ontario regulator yesterday to go through this again. But there's the funds that do not consider any ESG, even from a risk perspective, or, you know, nothing, absolutely nothing at all. It's purely focused on financials. There's what we would call kind of an ESG integrated bucket. So this is where risk mitigation from an ESG perspective is part of the investment process. And there you'll see a lot of the asset managers that have signed up and aligned with the UNPRI and other organizations. That's essentially where much of those assets should be. And then the third bucket is just a bucket of sustainable investment funds, which is where we would put obviously the Corporate Knights Global 100 fund and ETF that we're planning to launch. And there the regulators expect much more reporting, not just in terms of sales communication that we'll put on our website, but also in the regulated what we call the MRFPs in Ontario or in Canada. So we're required to actually talk about to investors, retail investors, exactly how ESG or sustainability is being implemented in the process and where it's driven decisions, you know, different buy-sell decisions or reallocation decisions in the fund, the importance of engagement or proxy voting in the fund as well. So this is they're you know, really doubling down on disclosure. So it's not exactly as prescriptive as we would have liked to see, but we do appreciate that they're allowing us the freedom and the flexibility to provide further disclosure for investors. So I wish I had a better answer, and I hope that all the asset managers, at least in Canada, are aligning on those 3 broad categories.
Well, thanks, Faith, and thanks, Sean, for beaming in from India, and Olaf from Waterloo, Ralph from Coburg, and everyone who's joined us here today. It's beautiful to see this new language coming together, and we've tagged about 10 trillion of sustainable revenues so far that are being made by real companies, real large companies, and about a little over $1 trillion of sustainable investment. And we look forward to reporting back in the coming months as those numbers shuttle upwards and put us on a trajectory to close the gap. That sort of 9 trillion a year that needs to be invested to get us to where we want to be by 2030 and into 2050. So thanks everyone for joining us, and have a wonderful week, and take care. Thank you.